Welcome back. Before we take a look at the day's business news, let's take a look at the stock indices across the GCC. The Dubai Chamber and ICC Regional Banking Commission, MENA, launched today the Uniform Rules for Bank Payment Obligation. According to officials, this will further enhance growth as well as benefit the trade sector across the Middle East and North Africa as it responds to the increasing cost pressures and changing risk dynamics due to the rising openness in developing markets. Developed by the ICC Banking Commission and SWIFT, the URBPO is an alternative means of settlement in international trade, according to officials. They said it is regarded as electronic letters of credit and will enable banks to offer flexible risk mitigation and financing services across the supply chain to their corporate customers. His Excellency Hamad Bouaimim, Director General of Dubai Chamber and Deputy Chair of ICC World Chambers Federation, said as a business facilitator they welcome the regional launch as this provides rules and tools to the trading community, benefiting the trade sector in general. The URBPO will be implemented from the 1st of July.
This is a new set of rules for international trade. So when we announce a new set of international rules, it just makes common sense to launch them or to actually publicise them and promote them in a core hub for international trade. And Dubai, the UAE, is itself a very fast-growing trade area, but more so, it's really a crossroad from trade and technology. So it's actually a gateway into the emerging markets, and it's the emerging markets that are driving trade.
Also today, the ICC Regional Banking Commission, MENA, revealed key findings of the Global Trade Finance Survey for 2013. Vincent O'Brien, Chair of Market Intelligence Group of the ICC Banking Commission, says the trends and challenges highlighted are critical for the industry to make well-informed decisions.
There is a huge lack of trade finance available in the world, okay? And that trade finance is particularly challenging for small to medium-sized companies who haven't got a long credit history and do not have the expertise. You need expertise to do in international trade and finance. The second thing I would highlight is the role of the multilateral development banks. The multilateral development banks take risks in markets that commercial banks would not consider to be risks they can take. For a very good reason, their objective is to promote trade and investment and alleviate poverty. Their role is growing at a phenomenal speed, and we should actually take this role model, I believe, and actually expand it out into a much larger mechanism. I think the third thing we need to be aware of, and it's not really good news, is that the level of defaults in this challenging world of ours are high.
Dubai has the 25th most expensive office space in the world and leads the Middle East, according to a new report by CB Richard Ellis Global Research and Consulting. International demand for high-quality office space in the Emirate has driven the average annual rental price to $92.57 per square foot. And according to Matthew Green, the head of research at CB Richard Ellis Middle East, this comes despite a high headline vacancy rate in Dubai. Green added that while there is a lot of space available overall, the availability of quality accommodation within prime areas of the city is actually limited, particularly when looking for larger space requirements. No other Middle East city made the top 50 list, and Dubai remains the destination of choice for global businesses looking to enter the region, driven by the city's economic prospects, world-class infrastructure, and the stable political environment in the UAE.
Basically, we're looking at the DIFC as the prime office location in Dubai, particularly, I think, for space within the Gate building. This is, the financial hub of the Emirates and arguably for the UAE. We've seen, I think, greater stability come into the Dubai office market over the past 18 months, and we may actually start to see some growth emerge there as well as we move forward through the rest of 2013. what we're seeing generally is actually a lack of good quality space within some of the more popular leasehold and free zone locations. So I think there's definitely some positive signs despite the high headline vacancy rate which we have in the market. The whole of the CBD is performing very well at the moment. You can see once you start to break down the vacancy rate. I mean, the CBD area is round about 15% vacancy. The headline vacancy rate is round about 45%. So you can see which areas are performing well. Certainly, all around the downtown, the DFC is going to maintain this level of performance moving forward, and I think they're going to continue to set the kind of the benchmark for rents in the Emirates.
Asia dominated the list with 5 of the top 10, including Finance Street and Jiangmen CBD in Beijing in 3rd and 4th, New Delhi in 5th, West Kowloon in Hong Kong in 6th, and Tokyo in 8th. London's West End was the second most expensive. Globally, occupancy costs rose 1.4% compared to a year earlier, as modest growth in the Americas and Asia Pacific was partly offset by a slight decrease in Europe.
I mean, I think there definitely has been some changes. I think we're seeing a rising prominence, I think, of the Chinese cities, something which maybe if you went back to 2008, maybe they weren't quite so prominent. And I think obviously that reflects the way that economic growth has been going over the past couple of years. I don't think it's any surprise to still see London West End up close to the top of the table, though I think they're likely to maintain that position kind of going forward. Certainly, I think always going to remain within the top 5 for the foreseeable future. We've seen now, obviously, Beijing is featured kind of strongly. Now actually have 2 of their kind of central locations that are actually kind of located within the top 10, which is something which we haven't seen much in this survey in the past. Obviously, London is one of the other key markets that actually manages to position itself with 2 locations there. But the rise of China, I think, is something which is going to continue. Hong Kong is another one which features strongly as well. We have the Hong Kong Central and also the West Kowloon area as well. So, there's a few key markets here which are really dominating the overall top 10, with New York picking up the end of it at number 10.
A delegation of the International Monetary Fund to the UAE has projected a 3.6% growth in the country's gross domestic product this year, according to a statement made on Sunday by the Ministry of Finance. The delegation's meetings with the UAE government were held from April 30th to May the 15th, and according to figures cited in the delegation's report, the UAE's economic growth will be driven by investments, trade, tourism, and logistics support. Growth is expected to rise to 3.7% in 2014 and 3.8% in 2015. Commenting on the IMF report, His Excellency Obaid Humaid Al Tayed, Ministry of State for Financial Affairs, was quoted in a local daily as saying that the final report of the IMF gave away a clear picture of the UAE's economy. In fact, the report highlighted a notable recovery from the financial crisis that engulfed the world, where the economy is actually witnessing strong growth, which guarantees a solid business environment for investors. According to the IMF delegation's report, the UAE's non-oil growth is expected to be 4.3% this year and projected an increase in the UAE's inflation rate to 2% in 2013, followed by an increase of 2.4% in 2014 and 2.5% in 2015. The report further added that total exports are set to reach $367 billion in 2013 and increase to $393 billion by 2014 and $420 billion in 2015. The US dollar rally was in full effect last week and entering into the new trading week as markets continue to digest the FOMC's announcement. Fed Chairman Ben Bernanke refrained from announcing any reductions to the current $85 billion a month asset purchase plan and instead left the door open to further reductions later in 2013. With markets positioning for a cut, they were left largely disappointed as the FOMC instead reduced future inflation and growth forecasts during 2013. Following the press conference, the risk-off trading took equities and commodity markets lower, with gold breaking through 1,300 levels and the Dow Industrial Average dropping through 15,000. The weakness continued into this week, with the dollar index consolidating between 82.5 and 83 levels. To find out more, we spoke to Gaurav Kashyap, the head of the DGCX desk at Alpari Middle East, to get his views on the dollar in the week ahead.
Markets opened this week on the back foot as they continue to struggle with the hangover following last week's FOMC rate decision. Now, of course, the risk-off trade dominated, keeping higher-yielding assets weaker against the US dollar. And we saw the US dollar consolidating between 82.50 and 83 levels, with the daily moving average at 82.56 providing a very good support level. Now, following last week's FOMC meeting, we did see Bernanke not change his rhetoric too much. He did maintain that cutting the existing monetary purchase plans would be relooked at some point in 2013. And along with this, he did revise downwards the growth forecasts and the inflation forecasts for the upcoming year. And this we saw had a very, very large impact on equity markets, US bond prices, and commodity sector, which was probably the largest hit. We saw gold crashing through 1,300 levels. It has normalized around 1270 to 1280 levels, but overall the forecast for gold in the week ahead remain very, very anemic. Also, if you look at the performance of the Indian rupee did slide back to 60 levels against the US dollar, similar to what we saw 2 weeks ago. This slide was halted after the RBI announced that they would be intervening into the currency markets, with action taking place on Thursday and Friday. So we saw the Indian rupee par some of its early losses last week. But overall, the conditions in the week ahead will remain anemic and will remain in favor of the US dollar. We will continue to watch how the data comes out of the US. We have some personal consumption figures. We have the US GDP reading, which is expected to remain unchanged at 2.4%. But once again, improving data will continue to improve the forecast for the US dollar in the week ahead. So overall, we expect the US dollar to remain well bought in the week ahead.